Welcome to You and Your Money. Today's episode features Laurence Hale, Senior Partner and Chief Investment Officer at WHZ Strategic Wealth Advisors.
It's so good to have you here today. We have a really timely issue here today, and that is how to separate headlines from reality when it comes to making financial decisions. It's what you do every day. And this is a great topic for sure. So we hear the headlines, we're living it, government shutdowns, tariff announcements, Fed rate decisions, markets hitting all-time highs one day and then dropping the next. When you're thinking about your 401k and your own retirement planning, how do you separate what actually matters from what's just noise?
Well, Gary, that's in some cases actually the $1,000,000 question. And you're absolutely right. We're definitely in a headline-heavy environment right now. We've got the government shutdown that's continuing. We see tariff announcements that have moved markets, and in the month that we just wrapped up, October, has historically been the most volatile month. And here's what we always tell clients: is headlines grab attention, and it's not necessarily to provide the context you need relative to you making good long-term financial decisions for yourself.
Give us an example.
Sure. Let's take the government shutdown. So headlines sound alarming, things like government shutdown enters second week. I think, what are we in week 5 now? Yeah. It always are said with an urgent undertone. But when you look at the data, investors have largely looked through this, and markets actually closed at record highs recently despite the shutdown. So you might ask yourself why. And historically, government shutdowns have had modest impacts on financial markets and the broader economy, especially if they're brief. This one isn't brief. It's the longest we've had. And the fact of the matter is that most economic activity when a government has the shutdown gets delayed and made up after the shutdown ends.
So the headline is frightening, but the reality is less dramatic.
Exactly. One sort of example I like to use is if you're going to get on an elevator and the buttons say soar or plunge, are you going to push those buttons? Sometimes the terminology matters, but in terms of the government shutdown, that doesn't mean they don't have real consequences, and we're seeing that for sure. Definitely across different parts of the economy, federal workers, people on government programs getting disproportionately impacted. But from a long-term perspective, they're typically not the catastrophic event that headline might suggest. That said, this is going on a long time. If it continues for a lot longer, we're definitely keeping our eyes on the impact it could have.
All right, let's talk about tariffs. It's frightening to hear about tariffs. And that seems to be moving the markets quite a bit. Tell me about that.
Particularly early in the year, and they are, and this is a perfect example of why we need to separate the headlines from the underlying reality. So, yeah, there are significant tariff announcements, including a 25% tariff on imported heavy trucks starting on October 1st. And ongoing discussions about tariffs on Chinese goods. Markets react to these headlines immediately, but here's what's interesting. While U.S. tariffs average 18% on paper, companies are effectively paying closer to 11% due to the exemptions, timing lags, and various workarounds. So the implementation is often messier and less dramatic than the announcement is.
Then there's a policy announcement. Then there's the actual economic impact, which might be quite different.
Right. Businesses are adapting rapidly. Supply chains are being restructured. Companies are finding new ways to navigate disruption. We've seen this story play out over the past several years. Markets have largely powered ahead despite political gridlock because companies and investors have proven remarkably adaptable.
And of course, you mentioned October, which is historically volatile. The crashes of 29 and 87 all happened in October. I think about it every October. Should that worry you? I mean, we're passing out.
Well, some average.
Yeah. So, but is that a worry? Do you think about that?
It's probably more psychological. It's definitely true that October has that reputation. And looking back over the last 40 years, the volatility of daily returns is actually higher in October than any other month of the year. But here's the context that often gets lost. Volatility isn't the same as long-term losses. So markets typically see 3 to 4 dips of about 5 to 10% each year on average. These are normal market movements, not necessarily signs of impending doom.
So 5% or even a 10% drop shouldn't automatically trigger panic?
Not at all. In fact, these dips can actually present opportunities for long-term investors to enter markets at more attractive prices. It's almost like things going on sale, if you think about it that way, or to rebalance their portfolios. Like we've said many times before, the key is having a plan in place before the volatility hits. not necessarily making decisions in the moment when emotions are running high.
All right. Let's stay with emotions for a minute, because I imagine that it's easier said than done. So you open your statement, you see your retirement account drop 10% in a week. That's not just numbers on a screen. That can feel really scary. What do you do?
Yeah, it absolutely can. And this is where behavioral finance becomes so important. Research consistently shows that emotions like fear and greed are not necessarily just side effects of market movements. They actually amplify and often dictate market swings. Fear can often lead to panic selling, even when the fundamentals of investments remain sound. And on the flip side, greed and overconfidence during bull markets can lead people to take on excessive risk.
Right. So how do you guard against making emotional decisions when the headlines are just screaming at you?
First, recognize these emotions are normal and they're universal. Studies show that the pain of losing money is psychologically much stronger than the pleasure of gaining the same amount. This is called loss aversion, and it can actually cause investors to sell at exactly the wrong time. So second, have a written financial plan that you created during more calm times, not necessarily during more market turbulence. That plan should include things like your goals, time horizon, risk tolerance, and your asset allocation strategy.
And you have to stick to that plan even when it doesn't feel right.
Especially, and especially when it's uncomfortable. And that's the whole point. When market drops sharply during the COVID pandemic back in March of 2020, investors who panicked and sold locked in their losses.
Yeah.
The S&P fell 66% from its high value. But those who stayed the course and even bought more saw those losses recovered and then some that year, and markets have gone on to new highs.
What about headlines, reflecting inflation, interest rates, and the Federal Reserve? How should we process that?
Yeah, the list goes on, and that's a great question. The Fed's preferred inflation measure of personal consumption expenditures index, PCE, showed that core inflation ran at 2.9 annual percentage rate in August. That's still a little bit above the Fed's 2% target, but definitely moving in the right direction. The Fed started cutting rates most recently last week, which is generally positive for markets. But here's what gets lost in the headline: whether inflation is at 2.9% or 2.5% or exactly at 2% isn't nearly as important for your personal financial plan as whether you're saving enough for retirement, whether you're properly diversified, or whether you have enough emergency reserves.
So again, we're coming back to big picture versus the daily noise.
Yeah, exactly. You don't get me wrong. These economic indicators matter, but they matter in the context of a comprehensive financial strategy, not as triggers for reactive decisions. And frankly, the Fed is watching these numbers far more closely than any individual investor can or should. Their job is to react to economic data. Your job is to stay focused on your long-term goals.
So we get back to headlines. We see that markets at our all-time highs. I hear some people say that means it's time to sell because there must be a drop coming.
This is one of the most common misperceptions out there. The markets spend a lot of time at or near all-time highs because over the long term, markets tend to go up. That's how capitalism works. Companies grow, they innovate and create value. The current bull market that started in October 2022 has seen the S&P roughly double in 3 years. History suggests that these bull markets typically last about 5 years and sometimes more. High valuations alone haven't necessarily been a clear signal for returns over the next 12 months.
So you're trying to time the market based on headlines? Not a good idea.
No, and more often than not, it's a losing proposition, and markets can pull back from here. Yeah, absolutely, they definitely can. But that's what they always do, pull back at some point. But trying to predict exactly when that might be is extremely difficult, even for professional investors. And what we know is that decades of research is that time in the markets beats timing the market. Investors who do the best typically are the ones who are patient. They stick with a diversified portfolio through ups and downs. We balance periodically and don't let headlines drive their decision making.
All right, let's bring it home, Laurence. What's the one thing we should remember when we see alarming financial headlines?
Gary, I say this: context is everything. Any individual headline, whether it's about tariffs, shutdowns, inflation, or market volatility, is just one piece of a much larger puzzle. Before making any significant financial decision based on a headline, ask yourself these 3 questions. First, does this actually affect my long-term goals? Second, am I reacting emotionally or strategically? And third, does this change anything about my carefully constructed financial plan? More often than not, the answer to the last question is no. If you're not sure, that's exactly the time you should be talking to a financial advisor who can help you see the bigger picture.
All right. Great advice always. And that's what Laurence and his team do at WHC Strategic Wealth Advisors. And that's what they're here for. If you're interested in learning more about how their plan well, invest well, live well, strategic financial process could help you, schedule a complimentary discovery session at their website, whcwealth.com, or call 860-928-2341. WHC Strategic Wealth Advisors are committed to providing each and every client with absolute confidence, unwavering partnership for life. Laurence, thanks for helping us out today. We appreciate it.
Absolutely. Yeah, great to be here.
For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit whzwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Marrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. WHZ Strategic Wealth. Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.